Let's look at Peter Thornhill's investing strategy for how to make $400,000 a year in dividends. Make sure you stay until the very end, where I tell you one of the most important things not to do when it comes to investing in dividends. If you're new to the channel and want to learn how to make more money, subscribe and click the bell. That way you'll never miss a video. So, who exactly is Peter Thornhill? Peter Thornhill has a net worth a little over $10 million after using a specific investing strategy for a long period of time. He now makes over $400,000 in dividends each year. For many decades, he worked in the finance industry and then retired to live off of his investments and teach others how to do the same. He's also a proponent of spending your money on shares in a business rather than investing in residential or commercial real estate. So let's take a look at some of his tips on how to make $400,000 a year off of dividends. Peter Thornhill's basic strategy is to invest for a growing income stream. The strategy is all about having a diversified portfolio of dividend-paying shares. The basic idea is that over a long period of time, a large group of businesses will earn more money and will pay higher dividends to shareholders. With the dividends increasing over time and the investor buying more shares, the income will grow so that the investor can live off of the dividends that the portfolio gives out each year. Now, this kind of strategy may not be for every person, but it is a nice method for building wealth and obtaining a stream of dividend income. Here are 7 simple steps to help you follow Peter Thornhill's philosophy. Step number 1. Don't spend more than you earn. Everyone knows the classic advice to save more money. This is a major step for building long-term wealth. Saving money is kind of like the vegetables of the financial world. No one wants to eat their veggies, but that's what's going to make you healthy and strong. And saving is what's going to make you financially healthy and strong. No one wants to save, but yet it's incredibly important. Regardless of your income level, you need to focus on saving at least some of your income. Step number 2. Borrow less than you can afford. This sounds easy, but not that many people put it into practice. Don't borrow to your limit just to buy the biggest house in the fanciest neighborhood that you can afford. If you want to be able to save more and invest more, it's important that you keep your living costs low. The best way to do this is to pay as little as you can in rent and in housing costs. So buy a home that's moderately priced and well within your ability to afford it. Step number 3. Invest in a diversified group of dividend-paying shares. Obviously, the entire goal is to have a portfolio of successful businesses that make plenty of money each year, so that way they can send some of that money to us each year in the form of dividends. There are ready-made baskets of companies that we can invest in easily. Peter likes to invest in LICs such as Argo, Milton, BKI, and Whitefield. Peter significantly prefers to invest in low-fee LICs over ETFs, particularly those that have been around for a while. These LICs invest in a large group of Australian companies, usually about 50 to 100 plus, which they anticipate will do well in the future and give out increasing dividends. They are long-term focused, lower cost, and have a lower turnover. They don't buy and sell often, which means that they are tax efficient. Investors just need to open a brokerage account and choose a fund or two to invest in. Step number 4. Buy more shares with your dividends. Something pretty awesome will happen after you buy your shares. You'll notice a nice little cash dividend deposited into your bank account every 6 months or so. This dividend income is your part of the earnings from all the companies that you've invested in. Since you are a part owner, you get some of the money that the company earns. The companies will use the rest of their earnings to grow and expand their business and make more money in the future. Now, this is the tempting part. Once you get your nice little dividend payment, you might want to go spend it on a new coffee maker or a fancy meal. However, it's important that you resist the urge to spend this money and instead put the cash toward buying more shares. This means that your future dividends will grow and you'll make more money with your future dividend income payments. Step number 5. Consider debt recycling if you have a mortgage. Peter Thornhill is a proponent of debt recycling. If you're someone who is investing and at the same time paying off your home, you can gradually transform your mortgage into an investment loan. The interest will then be tax deductible on an investment loan. However, this can be a confusing process, so make sure you have a really good understanding and do your research before doing this. If this sounds like something that might work for you and your financial situation, then recycling could be a very tax-efficient option. Step number 6. Build up your portfolio until your dividends outgrow your spending. Use your growing dividends and your monthly savings to continue to invest in and develop your portfolio. Over time, because of a company's increasing profits, your dividends will naturally increase. Now, if you're also adding more money in on top of that on a consistent basis, then your passive income will grow at an even faster rate. Of course, every once in a while, due to market fluctuations, the dividend payments may decrease every now and then. However, when we look at the long-term game, it is highly likely to grow and increase over time. At some point in the future, your dividend income will exceed your yearly spending. It pretty much depends on how much money you're putting into the process. Peter thinks it's best to have enough to cover 2 years' worth of expenses. For example, if you spend $80,000 a year, getting $160,000 is a good place to start. Step number 7. Live off your portfolio and retire. This is the moment you've been waiting for, the moment when you can finally retire and live off your sweet passive income from dividends. This is the moment where you've got a nice-looking portfolio and enough cash coming in to not only cover your yearly expenses, but to also cover 2 years' worth of living expenses if necessary. Now, it's time to keep an eye on your expenses and your income to make sure you are staying well within your budget. Of course, you've been doing this already, so it should be pretty easy. If there's some sort of economic disaster and the company's profits decrease, you can count on your saved up cash to pull you through for several years until your dividend income recovers. Now that we've looked at some steps you can take, let's look at what not to do. Here are 4 things you should avoid doing on your investing journey. Number 4, don't chase yield. Don't put your focus on high yield today. Put your attention on getting the highest income over a period of time. It's all about the long-term game. Basically, you can't just have a bunch of high-yield stocks or funds. If you want to grow your income in the future, you want to invest in companies that are growing. Number 3, don't compare your performance to others. If you start to compare your earnings with the earnings of your peers, this could cause you to stray away from your strategy and start chasing new hot stocks. Remember, this is a long-term strategy, so be prepared to be in it for the long haul and keep your eye on your goal. Don't start looking around and comparing yourself to others. Number 2, don't try to time the market. You can't stress out about what's going to happen to the markets a day from now, or a month from now, or a year from now. You can't guess what's coming. It's best to put your attention on the things that you can control, like saving up your money and reinvesting that money. This is how you get long-term positive results. Before I move on to number 1, please give this video a thumbs up and subscribe and click the bell. That way you'll be the first to see my next money-making video. Also, type the word yes in the comments below if you are going to try to make $400,000 a year in dividends. Number 1, don't constantly watch the market. It's important that you don't get wrapped up in the idea of watching every single movement and every single up and down. It can be exciting to watch money roll in and seeing your portfolio grow. However, constantly watching the market and looking at every little up and down likely won't add any value to your life. It'll probably cause more stress than happiness. If you want to learn how to make $1 million in 30 days, click the video on the screen. Here, I'll tell you how to start making $1 million in just a month.